Let's suppose we have this market. Now, where is the fair value gap in it? We have this fair value gap, and here's another fair value gap, and here's yet another fair value gap. How do we know which fair value gap will work? From which fair value gap should we take entry? Which fair value gap will reverse the market? Will the market reverse at this fair value gap? Will it reject this one, or will it reverse from this one or reject it as well? How will we know? So in today's video, we will learn exactly this. Along with this, we will answer some questions like, why FVGs attract the market like a magnet? Why does the market reverse from FVGs? Which FVG is going to work in a leg? Before understanding the answers to all these questions, it's important to know some basics. What are fair value gaps? What is consequent encroachment? What is fair value gap start momentum? What is a fair value gap fill? What is invasion? What is a volume gap? And what is a simple gap? So this is going to be an advanced video on fair value gaps. Let's start the video. AVG fair value gap. Here we have 3 candles. A fair value gap is a 3 consecutive candle pattern, meaning the fair value gap is formed by combining 3 candles. Let's see how it is formed. The high of the first candle's wick and the low of the third candle's wick. If there is a gap between them, then that is a fair value gap. This means if the wicks of the first candle and the third candle are overlapping, then it is not a fair value gap. Now let's look at a bearish fair value gap. Here we have 3 bearish candles. In this, the low of the first candle's wick and the high of the third candle's wick, if there is a gap between them. So that is our sell side fair value gap. Guys, if you ask me what is the most important thing in the market on which it runs, I would say fair value gaps. Sir Michael J. Huddleston, who has 30 years of experience in the market and who invented ICT, SMC, order blocks, and more, said that the market only runs on 2 things, liquidity and fair value gap rebalancing the imbalance. There are some basic components of fair value gaps, like consequent encroachment, fair value gap start, fair value gap fill. Before learning these, let me show you how fair value gaps look on charts. This is the GBP USD chart on the 4-hour time frame. Here you can see the high of the wick of the first candle and the low of the wick of the third candle do not match. There is a gap between them. We will mark this as a fair value gap from here to here. This is a fair value gap. Now, let's look at the next fair value gap. Here we have a sell side fair value gap. The low of the first candle's wick and the high of the third candle's wick. This is our sell side fair value gap. Lastly, we have one more fair value gap here. Even the smallest fair value gap works. As for which fair value gap we should trade, which will work and which will fail, where to place the stop loss, all these things we will see in the upcoming videos. Consequent encroachment. The center point of a fair value gap is called consequent encroachment. What is it? Let's learn through animation. This is our market, and here a fair value gap has formed. This is the fair value gap. The high of the first candle's wick and the low of the third candle's wick is called a fair value gap. Now, 50% of this fair value gap is what we call CE, or consequent encroachment. Let's see how we use it. We use CE for fair value gaps to determine the strength of a fair value gap. You need to see how strong it is. If the market dips into the fair value gap or touches the CE and closes above the fair value gap where it opened, that means it's a very good fair value gap. It can show us a strong reaction. If the market dips down, enters the fair value gap, but closes above the CE, makes it a valid fair value gap. We can trade on that too, and it will also give us a good reaction. Next, if the market comes down and closes directly below the CE, even though it may give a reaction, we will not trade on it. That would be an invalid fair value gap for us. When you gain more experience, you might consider trading on such gaps, but as a beginner, you should not. Now let's look at an example of consequent encroachment, CE. This is the USD JPY chart on the 4-hour time frame. Here you can see that we have a sell side fair value gap, the low of the first candle's wick and the high of the third candle's wick. I will turn on the middle line in the settings, and now we have the consequent encroachment at 50% of the fair value gap. If you look closely, the market dipped into the fair value gap and reached the CE, where it showed a strong reaction. This is a 4-hour candle, and all the candles close below the fair value gap, meaning we have a strong fair value gap. You can see how strong the reaction was. Let's look at another example of consequent encroachment. This is the ADUSD chart on the 15-minute time frame. We had a fair value gap here. The market dipped into it and closed above the CE, meaning this fair value gap is valid and we can trade on it. The market pushed upward. Then we have a third fair value gap, the high of the first candle's wick and the low of the third candle's wick. Now, if you look here, the market, I'll zoom in a bit, closed below the CE. As a beginner, you won't trade on this one because it's not valid for you. Now, let's learn about fair value gap start momentum and fair value gap fill through an animation. This is our market, and here's the fair value gap. And where is its consequent encroachment? It is here. The 50% mark of the fair value gap has appeared as its start. It's a bullish fair value gap, and the start won't happen below but above because the market has to come from above. So we call it the fair value gap start. Now, what does the fair value gap start do, and when does it come into play? You need to remember that the fair value gap start is useful when there is news or a large volume in the market. What the market does is it rises due to volume or news, creating a large fair value gap. The buyer's volume is in play, and the market only dips into the fair value gap start, and then boom, it goes up. I'm just telling you the psychology of the fair value gap start. Basically, we don't trade on it because by the time the fair value gap start forms, we are already in a trade. As intraday traders, we capture the New York or London volume. Now, what is a fair value gap fill? Here's our fair value gap, and this is its start, and here's the 50% point. When the fair value gap closes at this point, we call it the fair value gap fill. When the market directly fills the fair value gap, that's when we experience invasion. We'll learn more about invasion later, but for now, just remember that once the fair value gap is filled, we don't think about trading it anymore. We start considering invasion at that point. Let's look at an example of a fair value gap start. This is the gold market on the 1 hour time frame. This example is from when volume spiked during leap day. You may remember that the market hit an all-time high around that time and a lot of volume came into the market. A fair value gap was formed, and what did the market do? It just touched the fair value gap start, and then boom, the institutions entered with their buy orders. Even above, you'll notice that the market dipped slightly but moved upward from the recent fair value gap. The CE consequent encroachment was above, and you can see how high the market went, making an all-time high. Now let's look at an example of a fair value gap fill. This is the USD CHF chart on the 4 hour time frame. Here we had a sell-side fair value gap. This fair value gap was from here to here, a sell-side fair value gap. News came into the market and the market filled the entire fair value gap instantly. So this is a fair value gap fill. Now let's learn about invasion. What is invasion? Let's see through an animated example. Here we have the market, and this is a bullish side fair value gap. This is our CE consequent encroachment. The market retraces toward this fair value gap and directly fills it completely. Now, how will we use this? When the market retraces toward the fair value gap that it had previously filled, it will act as a rejection point, and we will take an entry for the sell side, targeting the sell side. This is where the concept of inverse fair value gap comes into play, but that's an advanced concept. To understand it, you need to know about the breaker block, which we call BPR. If you want to know, then comment below. I'll make a video on that later. Personally, I don't trade invasion because its win rate is average. It doesn't provide a good risk-reward ratio, and the risk management on it isn't great, so it's not a proper setup, but I'm explaining it so you're aware. Next, we have the volume gap. Let's see what that is. When there's a gap between the opening and closing prices of two candles, that's called a volume gap. If the wicks are overlapping, but there's a gap between their opening prices, that's a volume gap. It works similarly to a fair value gap. When the market retraces toward it, the market bounces and moves upward. Next, we have a simple gap. When there's a gap between both the wicks and the opening prices, it's called a simple gap. This also works just like a fair value gap. The market moves up, retraces, and then bounces from it. Let's move on to the main questions. The first question is, why do fair value gaps attract the market like a magnet? Guys, according to you, what is it that attracts the market towards itself? What is the thing in the market that works like a magnet? Yes, it's liquidity. And fair value gaps are liquidity. There are two types of liquidity: external range liquidity and internal range liquidity, and fair value gaps are internal range liquidity. Here we have the market, And now we have external range liquidity. The market moves from external range liquidity toward internal range liquidity. What is internal range liquidity? It's made up of fair value gaps, order blocks, and breaker blocks. After consuming external liquidity, the market always moves toward internal liquidity, and after taking internal liquidity, it moves back to external liquidity. I've explained all of this in my upcoming video on liquidity. So the answer to the question is, why do fair value gaps attract the market? Because they are liquidity, and liquidity always attracts the market. The next question is, why does the market reverse from a fair value gap? The answer to this is also liquidity. There are two types of liquidity in the market: draw-on liquidity and run-on liquidity. Draw-on liquidity means the market has liquidity resting in a fair value gap. The market will come to sweep this liquidity and then reverse. After consuming liquidity, the market reverses. This is called draw-on liquidity. Then we have run-on liquidity. What is run-on liquidity? Here we have the market, and we have two fair value gaps, this one and this one. What will the market do? It will first fill the first fair value gap completely, and then the second one as well. This is called run-on liquidity, which means the market consumes liquidity but doesn't reverse. In contrast, when the market consumes liquidity and reverses, it is called draw-on liquidity. How will we know which fair value gap will cause the market to reverse and which one will be filled? The answer lies in the next question. Which fair value gap is going to work in a leg? If there are 3, 4, or 5 fair value gaps in a leg, how do we know which one will work and which one will cause a market reversal? Which one should we take an entry on? Now let's learn this through an animated example. Here's our market. In this leg, let's identify where the fair value gaps are. One is here, the high of the first candle's wick and the low of the third candle's wick form a fair value gap. The second one is here, the third is here, and the fourth one is here. Now, out of these 4 fair value gaps, which one should we take an entry on? Which one will work? Let's look at them one by one. Step 1, premium versus discount zones. The first thing we need to check in the market is premium and discount zones. We'll apply the premium and discount zones here. If we are planning to buy, we will not trade on a fair value gap that is in the premium zone. We will invalidate it and say, we don't even want to talk to you. We'll ignore it. So which fair value gap is in the premium zone? The other 3 are in the discount zone. So this one in the premium zone is crossed out and we won't trade on it. Step 2, PD array overlap. Next, we'll check for PD array overlap. What is a PD array? Order blocks, breaker blocks, mitigation blocks, all of these fall under the PD array overlap. Now, we need to find out which fair value gap has an overlap with an order block, breaker block, or any other PD array. Look here, we have a breaker block overlapping with this fair value gap. So we found our breaker block. What is a breaker block? After this, a video on order blocks will come, followed by a video on breaker blocks. Now, look here, we had an order block, and there was an overlap with this order block. But this fair value gap has no overlap, so we will cross this one out as well. We won't trade on this either. Step 3, true day open. Now, we are left with 2 fair value gaps. We need to decide which one is ours to trade on. Next, you will check the true day open. Let's suppose the market opened here on the true day open. If you've watched the video on where institutions buy and sell, you'll know that you should never buy above the true day open. You should always buy below the true day open. The true day open is here, and buying will happen below it. Now, there's an order block, a fair value gap, and it's below the true day open in the discount zone. This is where you will take a buying position. You've checked everything step by step. The other fair value gap was above the true day open, so we'll cross that one out as well. This is where we'll make our entry. Now, let's see what the market does. The market reacted from this fair value gap, causing inducement, and then reacted again, which was also an inducement. The market will show smart money traders that it's going up. This is inducement. Then the market tapped into our fair value gap, our entry was triggered, and then boom, the market went directly to our take profit. This is how it works. Those who rely on IT, indicator trading, or SMC, smart money concepts, might take entries on the first fair value gap, then the second, and finally the third. By the time they get to the valid one, they might say, I've hit my stop loss 3 times already. There's no point in continuing. they might give up on trading by then. Guys, if there's anything in the video that you didn't understand, or if you have any confusion, write it down in a notebook and just ask me in the comment section. Making videos like this takes a lot of effort. Writing the script, creating animations, doing voiceovers, editing, creating thumbnails, etc. So if you've learned something new from this video, like the video, subscribe to my channel, and share it with your friends. Goodbye.